Hello, welcome to Business 7. It's always great to report about a company that is homegrown in Namibia and that is developing and investing in the country. And in that regard, in this program, we have our studio guest, Ben Jooste. He is the Chief Executive Officer of Oryx Properties, of course, listed on the Namibian Stock Exchange. And not only will he reflect on the group's past financial year performance, but he's also going to talk about some very, very ambitious investment plans. Please stay tuned.
Connection. It's in the human touch, the feeling of belonging. It inspires us and empowers us, creates clarity from complexity. It starts new conversations, unlocks the power of advice, and makes an impact on your life. At Alex Forbes, we pioneer insight to provide you with advice that connects your decisions of today to your impact tomorrow.
Our studio and the guest today is Ben Jooste, the Chief Executive Officer of Oryx Properties. Welcome, Ben, and thank you for your time.
Thank you.
We hear all about your financials, but also because of a great milestone in the group's history. You're 20 years old this year. So in a nutshell, if you can give us an overview of your financials for the past year.
Thank you. I think we've been very fortunate in the last year to come out with an excellent set of results. I've said to my board that it's certainly results that we didn't internally expect ourselves. And I think that's really down to some of the initiatives that we've taken on during COVID, where we really reduced our cost structures, where we really provided some rental relief to our tenants to maintain them within their premises. And that's helped us retain a 97% tenant retention during this year. From a profitability perspective, our profits have gone up by 950%, which is really good, and our earnings per share increased by about 100%. So the results were really good in our opinion. If you look at our expense management, then it's certainly best in industry, or a lot better than the industry benchmark. And I think given that our shareholders are allowing us to retain some of our earnings, has meant that we can manage our cash flows and our gearing quite well as well. So I think from a shareholder perspective, our yield has been 12.6% on the stock exchange, which is probably the best or one of the top two shares on the stock exchange, which also means that anyone buying the share at today's value will get a very decent return.
Of course, when we talk about, firstly, listed on the exchange, we're talking about the Namibian Stock Exchange, locally listed company. And also, what I always like to remind the audience of, when one talks about shareholders, you're really talking about the man in the street, because pension funds very heavily invested in companies like Oryx.
Yes, you're 100% right. So a lot of the pension funds are our shareholders, but we also have quite a big retail investor base, which is the gentleman or lady on the street. And I think that's what Oryx was set out to be, is an instrument or a company that anyone on the street can invest in and buy a small piece of a portfolio in Namibia. For our current share price, around about 10.25, anyone on the street can buy that little piece of Namibian history and be part of what we call a balanced portfolio, which includes retail properties, industrial properties, offices, as well as residential.
You touched on that point now, and I think it's worth expanding on. When one talks about Oryx, one thinks Marua Mall, but the group is so much more and in so many more sectors than just Marua Mall.
Yes, so Oryx have been through a wonderful journey, and as you've pointed out, it's our 20-year celebrations on the 2nd of December, and it's been a fantastic journey. We're saying we're becoming an adult now, moving on to our 21st year, but some assets that you may be familiar with also includes, apart from Marua, also includes the Gustav Fuchs Center in the CBD, the Baines Shopping Center, Urban Village in Elisenheim, and then we also have quite a lot of large industrial properties. So your FP de Toy building in Prosperita, your CIC building in the northern industrial parts, and several others. So it's quite an expanded portfolio of a size of about 3 billion at the moment.
And indeed, extremely balanced portfolio, and not just limited to Namibia. You're actually internationally exposed too.
Yes, so we made a decision in 2018 to diversify our portfolio and to have a hedge of international currency. And we invested a part investment in Croatia along with another partner, where we've got a 26% shareholding in a portfolio there. Also a balanced portfolio in Croatia, some retail assets, some industrial assets, and then also probably the best office tower in Zagreb in Croatia.
It's fascinating for a country and a company in Namibia to expand to Croatia. What was the thought behind that?
It's an interesting question. We looked at several countries before investing. Croatia was coming out of a very long recession, a multi-year, probably a 6-year recession, and our partners have already paid a lot of school fees and built a lot of good relationships with an incredible team on the ground. So it made a lot of sense for us. And I must say, it was absolutely the right decision. Through COVID, that portfolio has really carried our business, whereas normally it contributes about 10 to 12% of our distributions to our shareholder. It went up to 20-25%. So it was a significant contributor. Secondly, up until today, we've had 0 rental arrears in that portfolio, which is very different to the Namibian portfolio. And I think as a retail investor or an investor in Namibia, it would be nice to know that you have, or the company has, some sort of a hedge in a first world currency to protect you against the Namibian economy. Saying that, our key focus is on the Namibian economy. It's about building new buildings, expanding, and onto what we call Strategy 2025.
Just coming back to COVID for a moment, you had a lot of initiatives helping your tenants during COVID and still last year. Can you elaborate on that slightly?
Yeah, sure. We took a leading initiative in Namibia by joining some of the South African companies in South Africa to come up with a structure for COVID relief. So we were part of that group, and that also meant that given the size of your company, you would apply for some COVID relief depending on your sector, where you're located, etc. In total, Oryx gave about 50 million Namibian dollars in physical rental relief or discount, which hurt us pretty well, but it was the right thing to do, and it was the right thing to hold our tenants' hands. And I think that's helping us now, where we're keeping our places occupied, our tenants are paying rent, and it's really starting to help us now. So we had a massive rental relief program on the one side. We also did a lot of food initiatives with some of our retailers, and it was so lovely to engage with these retailers, that's our tenants, where our retailers have been extremely giving in terms of products, and then we've gone to different areas of the country to deliver food parcels.
I certainly have to admit that a retention of, like you say, 97% is truly impressive in this economy. Moving over to retail specifically, because it is one of the pillars of the economy. Very, very tough time for the retail sector as such since about 2016, when we started moving into the recession. But what is the state of the Namibian consumer at the moment?
Look, the Namibian consumer is certainly struggling, and I think we've got to keep in mind that Namibia came out of a recession, a multi-year recession, then COVID, and now in a high inflation type of environment where interest rates are going up. So certainly the consumer is under pressure. However, I don't think it's all doom and gloom. I think retail is evolving and retail is maturing, and we can certainly see the feet are back within the centres, and that's not just the Maruas of the world, the other centres as well. So in Marua's terms, as an example, our feet counts are higher than the 2019 levels before COVID. The spend has not been pre-2019, and we're helping that. But within the last 6 months, our feet counts have been up anything between 20 and 40%, depending on the month that you're looking at. And our turnovers within the centre as a whole have been up anything between 10 and 15%. So not a direct translation in terms of feet versus spend, but certainly the consumer is spending a lot. I think with Black Friday coming up on Friday, a lot of the consumers are wanting to make use of some really good specials and early Christmas present buying. So that will hopefully help the tenants and the landlords as well. But I think certainly retail is making a rebound. Our rental reversions, which is basically your rent that you enter into on expiry of a lease, have been negative in retail now for the best part of 2 or 3 years, and we're seeing that turning positive again. So retail is certainly making a rebound. I think the oil discoveries and a lot of the good things that's coming out of these green hydrogen projects and others will make a big difference within the Namibian economy. And if we can get through the next sort of 18 months, see inflation stabilize, see interest rates stabilize, then the economy should improve.
I have an off-the-cuff question here. I wanted to ask it when you were busy with the financials, and then we got sidetracked. But for the layman, a property company, to read its financials can sometimes be confusing because you have distribution per linked unit, whereas other companies or like banks, etc., they talk about dividends. In layman's terms, what is the difference?
The difference is we're a property loan stock. In South Africa, you've got what they call a REIT. So in the REIT space, it is a dividend. But because we don't have that legislation in Namibia, we're still a property loan stock, which means that that share or that equity that your shareholder gives to you is given in the form of a loan. So you're paying him interest as you would pay to a bank. So that's why we call it a distribution interest per linked unit. In essence, for the layman on the street, it's very similar. It's a very similar structure, and your yield is basically the return that you receive from us as the company. So very similar.
There you have it. So next time you read, you know exactly what that is about. Coming back to the retail space, you alluded to a change in sentiment from the consumer side. What do you think is driving this?
I think the consumers have been stuck in COVID in their houses. All of us have been, and it's now quite nice to be out in the open again, meet your friends, having a social time, you know, within some of these centers or other areas, and that's driving people to come back to these centers. But I also think the consumer trends are changing. They're looking to connect in different ways. They're looking for a lot more social connection points within your center. They're looking for a lot more experiential type of activities within your center, like the new train we've got in Marua, which is making a big impact. And the consumers are loving that. And, and I think for landlords like us, we've got to adapt, and we've got to really understand what that consumer wants. For instance, outdoor restaurants have become a big thing. So we are very excited with some of the Marua redevelopments where we're building what we call the clip-on, and that will through that we will build outside restaurants. We've signed fantastic restaurants from South Africa that's not in Namibia yet. So we're quite excited that we're going to provide a brilliant offering to the consumer.
Sounds very exciting. I'm curious about those restaurants. And yes, the train is making a massive difference. My grandson only wants to go there because he wants to ride the train. It's an awesome initiative from you guys. Coming back to the immediate future and what Oryx is referring to as Strategy 2025. What is that about?
Yes, we are incredibly excited about a very ambitious strategy for the next 3 years. We want to build what we call a more meaningful fund, and that also means that we need to venture out into the rest of the country, look at other regions, expand our portfolio to what we call a more meaningful fund, and that's about a 4.5 billion portfolio. So it's about a 60% growth in portfolio, quite an aggressive target, but definitely a doable target. And I think at the moment, if you look at the opportunities, there's definitely assets that's yielding well, better than maybe before COVID, where people are more, their price expectations are maybe more realistic, and therefore we are quite excited about it. So for the next 3 years, we're on a significant growth strategy. We believe that we can buy assets that will be beneficial to our earnings and to our shareholders, and therefore now is a good time to do so. So our aim will be to look at some of these other regions, look at the northern areas regions, look at the Irongo regions, and obviously the Ludus type of areas that's now starting to boom, and through that maintain that balanced income fund, but also manage to reduce our large risks within our portfolio. So for instance, in our portfolio, Marua is probably 50% of the portfolio. So to reduce the the exposure of that within an entire portfolio and growing it to, as I said, 4.5 billion.
Certainly sounds sensible. According to your integrated annual report, this strategy will look further than retail assets, etc. You've got some very interesting ideas in what you want to invest in terms of property assets.
Yes. If you look at the property industry as a whole and also globally, then it's become highly specialized in some areas, and there's certainly some sectors that we still don't play in. For instance, one of the sectors up and coming is the medical sector,
Yes,
which is doing really well, and we believe there's a big demand for that in Namibia. You've got your storage sectors, which is doing phenomenally well in South Africa as an example, and we believe there's a lot of scope for that in Namibia as well. And then you've got your mobile towers, where you've got REITs that's only focusing on mobile towers, now one in South Africa, but also globally. So we're looking at other sub-property sectors that we are not in at the moment. And once we've built the skill set and the speciality around it, then that's something that we look to invest in.
Of course, a massive investment drive like you are targeting will have huge spillover effects. The moment you go into a property, there's also other sectors that benefit from that investment.
Yes, sure. I think that's our purpose, is to really expand on the Namibian economy. And you've seen in COVID that we've had 2 or 3 big projects where even in COVID times, in the final recession before we hit COVID, we were investing. So as an example, we built the Elisenheim shopping center in Elisenheim, and the idea was really to give that community, some sort of form of retail and convenience, and I think that's doing exceptionally well, and we'll continue to do so. So evidently, whatever projects we do, there's a lot of job creation, and we try and also do sustainable job creation that is not just from a project perspective, but obviously when those assets are up and running and trading, that there are sustained jobs within those assets.
You mentioned just now that you're building a skill set for this new investment drive. What does that entail?
So at the moment, we are really starting to specialize on asset management. At the moment, our asset management and property management teams are in one team. So really our idea will be to split the two and really to become specialists at asset management. We're seeing that maturity in other regions, in South Africa, but specifically also the UK, and that's something that we'll look to replicate. And I think the value that those teams can create, will be significant for our shareholders.
Well, Ben, thank you very much for joining us. Once again, hearty congratulations on 2 decades in Namibia. It's wonderful to see a homegrown Namibian company flourishing. We are looking forward to having you back to report back on some of these exciting initiatives that you're embarking on.
Thank you very much, and thanks for your listeners. Thanks.
Every day, you make choices that make you legendary. Journey together with us on the path to securing your legacy as a member of the League of Legends. With the Select Platinum Bundle Fee Premium Bank offering, you will access tools that will enable you to thrive. If you earn 850,000 Namibian dollars per annum or more, you can apply for this offering today via bankvinted.com.na for only 447 Namibian dollars per month. Bank Vinted, a member of Capricorn Group.
No doubt, green hydrogen will become a very competitive playing field. Not only does Namibia have huge ambitions about this sector, but so does its southern neighbor South Africa. Reuters filed this report on the South Africans' plans.
The sun glinting off solar panels in South Africa is a sign of a potentially brighter energy future for the country and indeed the wider continent. This facility in Vredendal has been set up to prove the concept of producing green hydrogen. That's important because green hydrogen is a central pillar of South Africa's plan to transition away from polluting coal. But there are question marks over whether Africa's most industrialized nation is ready to profit. Dr. Stanford Chidziva is the acting director of green hydrogen at the University of Western Cape's South African Institute for Advanced Materials Chemistry. It has partnered with a joint venture including Keren Energy to develop the project which, as he explains, uses 2 electrolyzer hydrogen stacks powered by the sun.
We supply them with pure water, and the process of electrolysis takes place in these 2 electrolyzer stacks. And when electrolysis happens here, water is split into hydrogen and oxygen.
Though the Vredendal site only produces small amounts of green hydrogen, Keren Energy has plans to upscale the project nearby, says Executive Director George van Rensburg.
The commercial plant in Van Rensdorp will use about 10 megawatts of solar power, solar PV power, to power a 6 to 8 megawatts electrolyzer, and we will produce roughly about 1,000 kilograms of hydrogen per day.
At COP27, delegates expressed high hopes for the nascent industry. However, speaking at the climate talks, Egypt's President Abdel Fattah al-Sisi warned that developing countries remain less able to benefit from the opportunities offered by the rapid green hydrogen transition.
This is due to developing countries' weak technological capacity in this new field, the lack of necessary infrastructure to transport, store, and create the required supply chains for safe trade.
South Africa is not immune to such challenges. A plan presented at the summit says the country could produce over 5 million tonnes of green hydrogen by 2040. But the government also estimates that, to realise its vision, it will need up to 100 gigawatts of additional solar and wind power capacity at a cost of close to $133 billion. According to Boston Consultancy Group, South Africa will need to set up 6 to 7 gigawatts of renewable capacity per year for the next 2 decades. That compares with the 6 gigawatts it has managed in total since 2011. One barrier, says Chris Yelland, Managing Director and Energy Analyst at EE Business Intelligence, is the public procurement process.
The procurement processes are like a dinosaur in a modern world.
He said the system is mired in bureaucracy and legal challenge.
But do not think that renewable energy is not happening in South Africa in a big way. But it's not happening through the public procurement process. So if we're to look at the domestic, commercial, the light industrial, the heavy industrial, the mining, agricultural sectors, the customers of electricity are taking control of their own future.
South African petrochemicals company Sasol and ArcelorMittal South Africa have announced that they are partnering to explore carbon capture and steel production using green hydrogen. Sasol is the world's biggest producer of fuel products and chemicals from coal. ArcelorMittal South Africa is the continent's biggest steel producer. Green hydrogen is one of 3 prongs in South Africa's transition plan. The other 2 are replacing its aging fleet of coal-fired power stations with wind and solar, and kickstarting an electric vehicle revolution. Retiring coal, though, and its impact on jobs is a thorny issue. With President Cyril Ramaphosa under pressure in various ways, Yelland says, the political situation in the country is on a knife edge. But if the barriers can be overcome, then South Africa could be heading, in terms of renewable energy at least, for greener pastures.
Thank you so much to FNB for this opportunity. Thank you so much to FNB. What an experience. I never got to do shopping in 5 minutes, but look at all this.
As always, we also have news on the African business scene, that report compiled by Reuters, and we're going to play out with that. Until next week, stay well.
Here are 5 business stories making headlines in sub-Saharan Africa this week. Kenya is set to import its first genetically modified maize, the Trade Cabinet Secretary has said, as it seeks to ease food shortages caused by East Africa's worst drought in 40 years. Local media reported that Kenya will, on Friday, authorise duty-free importation of 10 million bags of maize over the next 6 months, some of which will be genetically modified. Ethiopia has reactivated the process of selling a 40% stake in state-owned Ethio Telecom, as well as a separate plan to issue a second full telecoms licence, the Finance Ministry and telecoms regulator said on Wednesday. Efforts to lure investment as the economy is opened up under Prime Minister Abiy Ahmed have been hit by 2 years of war in Tigray. France's HDF Energy is set to develop Uganda's first green hydrogen power plant after signing a memorandum of understanding. That's according to a statement issued by HDF and the Ugandan government, which did not detail the capacity of the plant or the size of the investment. South Africa's Eskom has warned that planned maintenance could cause power outages lasting up to a year. Over the past 6 months, the country, which relies on the state utility's aging fleet of coal-fired power plants, has already suffered its worst power cuts in years. And finally, a senior official at Actis, one of the biggest investors of private capital in Africa, has said it could invest up to $300 million a year in renewable and gas-fired power projects on the continent. Head of Energy in the Middle East and Africa, Lisa Pinsley, said Actis has the funds and the appetite, and that it's just a question of finding the right opportunity.